Okay, so we finished all the core principles contained within IAS 18. We've done a lot of lectures and a lot of class examples. Now we're going to be discussing some illustrative examples specifically for sale of goods. Now when I say illustrative examples, I'm referring to the illustrative examples that accompany IAS 18. Remember, they are not part of IAS 18, okay? i.e. they are not found in Book A of the standards. They are found in Book B and are actually marked out as illustrative examples, and you'll see IE next to each paragraph number. Then remember that if you're looking at this from a few years ago, we never had Book A and Book B. Previously, we would have an appendix attached to IAS 18. All of those items from the appendix have just been transferred into the illustrative examples. These illustrative examples are just a standard set of giving us some more detailed guidance on how to apply the revenue recognition principles to specific types of transactions. So I'm covering a few of them here, the ones that I feel are the most common. This does not in any means cover every single type of revenue transaction contained in those illustrative examples. So first up, we'll discuss bill and hold sales. What is a bill and hold sale? Well, here, delivery is delayed at the buyer's request. However, the buyer still takes title and accepts billing. So when do we recognize revenue? Do we have to wait until delivery takes place? No. Revenue can be recognized earlier provided that it's probable that delivery will be made, that the item is on hand and ready for delivery. That's very important. The buyer must acknowledge the deferred delivery instructions. That may be by email, fax, written letter. And the usual payment terms must apply. If all of those criteria are met, then the risks and rewards are deemed to be transferred before delivery. When those are all met, you can recognize revenue. Okay, next up, goods shipped subject to conditions. Now this can relate to a huge array of actual revenue transactions. Here we're going to focus more on installation and inspection that is attached to a sale. So revenue is recognized when the buyer accepts delivery and when delivery and or inspection are complete. Okay. However, revenue may be recognized earlier, i.e. upon delivery, if the installation process is simple, okay, or in the case of commodities, if the inspection is performed only for final determination of a contract price, i.e. you've delivered sugar, iron ore, gold ore, etc., and the final inspection is only there to certify the quantity and the grade for price determination. Then you can recognize revenue earlier, not when the inspection and or installation are complete. Okay, those are two very important ones. I'm going to deal with some class examples on this later on. Layaway or lay-by sales. Here, ladies and gentlemen, you've got to understand the payments and legal terms around this. Okay, in a normal credit sale, I, as the seller who is recognizing revenue, will sell to my buyer on credit. Okay, the buyer will accept the invoice or the billing and take the product straight away and then pay me off over 30, 60, 90 days. Where a layaway sale is different is that me as the seller, okay, do not yet trust the buyer's credit rating. So I will enter into a lay-by or layaway sale where the buyer will come into my shop, my business, buy an item from me but not take delivery. He will, however, agree to pay off the settlement price over a period. Okay, that's very different to normal credit terms where I give up delivery and receive delayed payments. Whereas with layaway sale, I do not give up delivery, but the buyer still gives me installments to pay off the amount. When they are finished paying off the amount, then they come and take up delivery and I give up the product. Okay, so bit clearer, layaway equals when goods are delivered only when the buyer makes the final payment of a series of installments. Okay, so the normal thinking here, your default is revenue will be recognized when the goods are delivered. However, if experience indicates that most sales such as this are consummated, revenue may be recognized before delivery when a significant deposit is received and the goods are on hand, identified, and ready to deliver. So you've taken that item that person has purchased from you, put it aside, identified it, and it can be delivered at any point. There is a bit of debate over significant deposit. Again, the standard doesn't give an absolute percentage, 50%, 60%, 80% of the amount. Here you need to use your professional judgment, and I'd be happy to say that as long as it's more than 50%, I think we're in the game. Okay. So that's layaway sales. Again, I've got a class example coming up after these videos. So some other sales of goods. Often, a buyer will negotiate with you, the seller, to have a limited right of return, and there may be some uncertainty about the possibility of the return of goods. Okay. Then you will recognize revenue only when the shipment has formally been accepted by the buyer, or the goods have been delivered and the time period for rejection or return has elapsed. Okay, so there, again, some professional judgment, but you need to apply your mind to that in practice. The last couple of ones, consignment sales, should be nice and easy. Here's where I sell to a store, but the store does not yet believe that it will sell my product. So my clients will come to me and say, listen, give me 5 of your product. I'll put it on the shelf, and if it sells, then he'll pay me. Okay. If it doesn't sell, he'll return the product to me. So here, the risks and returns have not yet been transferred. Okay. So here, the buyer is selling goods on behalf of me, the seller. Okay. I will only recognize revenue when the goods are sold by my client to a third party. Okay, so that's pretty straightforward. Cash on delivery sales, well, those are pretty straightforward. Revenue will be recognized when the goods are delivered and the cash is received. Okay, so I hope that has helped you. Please go and work through all of these illustrative examples for sale of goods. There are also some for services, which we'll cover in the next video. Thank you.